the world. Yesterday, I didn't stream, and man, did I miss out. And Lord, at least I was putting out long dollar trades before the ADP number came out. I was bullish dollar, and man, oh man, I had some excellent trades yesterday. Excellent. And we're going to go ahead and keep that going today, because very, very likely, the market's going to experience a little bit of deja vu. Hey, James. Nice to see you. Always nice. Yeah, this employment data probably going to hit the markets real hard today. Notice how I don't have my webcam up again today. It says, again, I used my camera during the 4th of July for taking pictures and whatnot. I began to set it up yesterday, and then, well, the reason I didn't stream yesterday is this. I had a bit of a family emergency. I had to go down to the hospital, take care of a few things. So I never ended up getting any sleep all day long. And I ended up having to just make sure everything was fine, take care of things for a good old 14 hours straight. Everything's fine, everyone's okay, but man, family emergencies are never quite fun. However, it's a good thing to maybe share this message, to share this lesson. You know, even though I made money yesterday on all my trades before those, before, during, and after those events, the truth is that trading can always wait on those events. As soon as I got the call about the emergency, I dropped everything when it came down to trading. There are some people who can't do that because they have too much risk on. It's constantly in the back of their head, like, oh man, I got a couple $1,000, I got a couple $100 here at risk. If I leave my computer for the next 30 minutes, I might lose it all. Guys, your family and your friends and your girlfriends and your boyfriends and people around you in your life are a little more important than the next 24 hours of market action. Like 99.99% of the time. Literally, there may be only like one day in your entire life where, in retrospect, oh, I could have made this much more money, and then that could have paid off XYZ bill, right? You may be able to give me one extreme example of where it might be okay, but in principle, you cannot do that. So, sure, I can share this nice story of, how I went and took care of a family emergency, and not only that, but because of how I trade, took care of all my risks and didn't have to worry a bit. I literally checked, I didn't even bring my phone with me. And it was only after everything kind of settled down and was fine. I was talking with one of the nurses, and she was asking me, oh, what do you do? At that point, it's like the crisis is over. I told her what I did, and we talked for a bit. I'm like, I wonder what happened. All the trading should be over by now. By that time, it was like 3 hours after New York, after the ADP number came out. I had no idea what happened. And let me use her phone to check the markets, and I was like, oh my god. And then we, just talked for like 10, 15 minutes. It was like, oh yeah, wow, I made, like 100 pips on just Aussie dollar today. Insane. And then when I got home, I went ahead and I posted all my trade updates. Yeah. Nutty. Nutty. And that's the end of the story time with Joe. Let's check out the chat. Hey, nice to see you in here, Leon. But yeah, yesterday was quite eventful, for sure. So, today we have US employment data. And I have a serious thought that we're going to get a case of deja vu here for the markets. You can see how Bitcoin reacted to the markets yesterday up here in the top right. That wasn't so hot. How we rallied up into the data as well, right? And then also check this out. Yesterday on gold, we rallied down into the data, and then we got some EIA data. Also, Russia just came out with a new statement saying, like, hey, we're probably going to end up doing some more cutting, apparently. So that's holding up the price for, like, the last, I don't know, 20 or so minutes. The dollar is currently falling into the US data, but guess, I'm going to enlarge this. Guys, just look at where it's falling into. You see the bump? You see the hump, right? Hit me up. Call me when we're past this this little bearish threshold here at S1, right? Like, you guys can see, right? Oh yeah, I gotta zoom in here. Sorry, it might have been a little too small. You guys can see, right, like how we have a lot of our lows for the day coming in right around here above S1, and I can say, oh, roughly around 102.9, roughly in this 10-point range here on the index. We'll probably find the low for the day. And then maybe once you start getting past this S1 pivot, I probably am going to have to worry because I have a lot more uncertainty as to where the low is likely to be for the day here. So, just like the story from yesterday, we fell into the US data. The dollar got weaker going into the data. And then it got strong, rip-roaring strong when the data came out. Now we're tiptoeing into the exact same direction instead of charging down into it. We're just tiptoeing into it because everyone's afraid of getting their hand ripped off like they did yesterday. So we're going to tiptoe, try it again. And you know what? Even if the data is moderately okay, because given yesterday's data was a bunch of surprises, right? The ISM data came out 2 points higher than expected. The ADP data came out twice as high as expected. Well, we have a plethora of US employment data coming out. I'm going to a real quick screenshot so you can just see, like, the absolute. Look at this. Look at this for a second, you guys. Look at all these reports coming out here. And look, 2 of these are also for Canada. So, US NFP, average earnings, payrolls. Like, oh my God. So much US employment data. But, this is par for the course when it comes down to US employment data. This isn't something new, right? We've been doing this for a long time. The only thing that's probably going to make difference is non-farm payrolls are expected to come out lower than expected, well, lower than the prior number, about 100,000 lower than the prior number. Average earnings is expected to come down. Private payrolls are expected to come down. So literally, if the economic data, if the jobs data just comes out sideways relative to what they did in the prior print, then that in and of itself is going to be a positive surprise. So, yeah, it's going to be a little bit nutty. Alrighty. Well, if you guys got any requests, I'll go ahead and do some requests because literally, as far as the macro data goes, we gotta wait, like, I don't know, what is it, another 50 or so minutes until that data comes out at 5:30. That is the time for the stream right now is at 4. We're at 4:41 right now on the stream. So we can go ahead and do analysis on a ton of different assets in preparation for this event. I think I'll start off with pulling up Aussie. So this was the trade that I took yesterday. You know, it was kind of interesting here. I'll even sec. I'll go ahead and even pull up the chart that I posted in my trade group with like all the fancy drawings and whatnot. Copy image. Yeah, check this out. So this is a whole demo of me doing my trades. So this is another reason why I emphasize the style of positioning that I like to use. The 20, 30, 50 style of positioning. You know, when people go out and they give all this, you know, trading advice of, you know, risk 1% of your account, I always wonder, you know, have you ever lost 3 or 4 trades in a row, my man? Do you know what risking 1% of your account does when you lose 3 or 4 or 5 trades in a row? Because there is a non-zero chance that happens. It effectively is guaranteed to happen to you at least once in your trading career. If you plan to make it a career, you will at some point have multiple losses in a row of that consistency, especially if you're doing discretionary trading, right? Unless you have some, like, you know, market making bot thing that's like scalping 5 or 6 pips at a time because you're looking at, you know, some crazy little anomaly, right? But, you know, something like this, it's like, hey, if you manage your risk right, it doesn't matter if you sell here, literally at the bottom of this wick, or, and then also sell at the top effectively for the day as well. Because that's what I did effectively yesterday. I sold here at this bottom wick, and I also sold up here. However, this first trade right down here, that was 20 basis points. So put in 20 right there. And this up here was 30 basis points. So instead of having my net position be smack dab right in the middle, my net position was actually closer to my second entry, which, because it was so high up, dramatically helped reduce my risk. As far as once this big drop actually came in, right, as soon as we actually started falling on the day, I had nothing to worry about, because it's like, hey, my break even is right here now. Instead of being like right around here, I ended up making more money because I left some ammo in the bag. So then I could, instead of eating up a huge, you know, 40, 50 pip drawdown and not having any more money to put in at the more attractive prices for the day, because my conviction was that this thing was going to go lower, right? Which is why I even shorted down here. The fact is, oh, I had some extra cashola available. There's this nice pullback. My conviction's still the same. Why don't I go ahead and significantly mitigate this drawdown and increase my likelihood of getting paid by adding not just up here, right, but also adding a bit more size, right? 20 basis points here, 30 basis points up here. Bigger size. I ended up adding a little bit more than 30. I ended up going straight, I think, to like 50. I did a little more than 30 basis points. It was 50 basis points in total up here that I did. So I really skewed it a little higher. So instead of just having like a flat net, effectively having my net position be right in between those two trades, my net position skewed closer to the higher up, more attractive trade. And it's just like, you're not going to have the money available to do this type of positioning and risk management in your trade if you blow your whole load on a 1%er right here, right? You're just, oh man, one of the reasons why I like, instead of doing 1% risk, doing 20 basis points, which is 0.2% risk on the first entry into a position, right? So if your position is like here, short Aussie dollar, that's the position, that's the conviction. The first trade into that position that I do is 20 basis points. Because look, this is exactly why as soon as I got in over here, the thing rocketed against me 40, 50 pips, like within 2 hours, 3 hours. If I had put the whole 1% here, it's just like, oh my god, there goes all of my margin, right? Now I also have to overexpose and put on not just 1% of my account. I have to put on 2 or 3% of my account to actually in a meaningful way bring my net position up high enough so then even if these red bars didn't occur, just to get my net position up higher, like, it's too much risk, right? It's just too much risk. So the smaller 20 basis points just helps so significantly with not getting taken advantage of when these sorts of drawdowns occur, because this is definitely this is a big jump in your volatility compared to over the last 2 days effectively of trading. This bar here is greater than it. I mean, the next bar that's the same size is roughly over here. I mean, it's roughly 2 days ago. So if you're taking a trade and still anticipating this sort of volatility like I was, it's like, oh, cool, all right, and then all of a sudden this volatility comes in, draws you down. It's like, crap. But because I did 20 basis points, I didn't go, balls to the walls. Not only did it not really phase me at all, but I had significant margin available to do appropriate risk management and get in and bring my net position up at much more attractive prices for my short Aussie dollar conviction. So it's just little things like that, not getting taken away from when you first start expressing a position. Just, man, one of the things that has helped me for sure has been using pivot probabilities for, my statistics and these range probabilities for my statistics, yeah. But arguably just as much has been, as far as trading mechanics go, getting in and out, making my discretionary decisions, is the sizing, right? And 20, 30, 50 basis points positioning style is just, it's such an automatic improvement. Yeah, it takes away as far as the psychology part of it goes, it takes away so much of the stress and strain. Anyway, so there's the second rant on today. First is like, oh, why didn't I stream yesterday? Outside of holidays and emergencies, I'm always going to be streaming on the work days, guys. Let's see here. James Aussie Yen. We're going to go ahead and take a look-see at the Bitcoin after this. Let's go ahead and load up our range probabilities here. Ooh, check that out. I think I see a bimodal distribution here. So, see, yep, right there. I see this sort of shape. So this area right here, that's your secondary low, right? This is where you want to get in, right? And then a stop at that S2 pivot looks good. based off these stats. So a stop at that S2 and buying that about 3 hours ago was the right thing to do, it looks like. At least as far as the risk management goes and on interpreting this here, looks good. As far as right now, I don't know. Let's look at the closing odds. Yeah, but you're just anticipating maybe a bit of positive drift here. Based off the macro. There we go. Discord. Go to my announcements where I put all my show notes. Yeah, Udaya comments on how yen weakness is undesirable. Also on the sidelines for any yield curve control changes. Yeah, so it looks like people at the BOJ are getting a little more. They're talking a little more aggressively when it comes down to the yen stuff. Yeah, definitely. I mean, just look at this. Last 3 days, it's been getting hit so hard. So hard. Oh my god. Will this stop? Um, Probably not if the US data is strong again. Let's see here. Let's head on over to the Bitcoin. So here's Bitcoin. It's got a bit of a negative drift right now as far as expectations for where we'll end up closing. Probably around this S0.5. So the low for the day, I don't know. Low for the day is probably, I'd argue low for the day is probably in. Yeah. So maybe you get a little bit of a drift lower here on the day. Guys, remember, when it comes down to Bitcoin's appreciation, it's a discretionary item. And by discretionary item, it means when you have extra money available to invest and spend, that's when Bitcoin does best. Now, there are fundamental underlying factors in Bitcoin's supply that effectively make it an infinite money glitch. However, for Bitcoin's price to express those underlying macroeconomic factors requires years for it to properly express itself. Years. And there's no guarantee that you're going to have parabolic moves just based off that factor alone. So, if we're going into an economic regime where it's uncouth to spend a whole lot of money, then what do you think is going to happen to Bitcoin that requires you to spend a whole lot of money? It's just going to have this sideways, it's just going to have a small drift. And that drift is going to be based off the news of the day. So it can be a positive drift, a slight negative drift, a sideways drift. The ETF news has been particularly good. We also posted this actually in the Outlooks channel on the Plan to Profit Discord. Yeah, check this out. Bitcoin Monthly, dawn of the ETF era. So this is a whole breakdown by ARK Invest on what's happened to Bitcoin in the last month and a short little outlook on by them. Look, guys, they got billions of dollars still. You know, I know there are people who are like, "Oh man, but ARK is Cathie Wood, and I'm not a huge fan of Cathie McWooden." Guys, you know, people will think Cathie Wood's an idiot, but personally, I'm gonna stand behind her. Like, I think she knows she got an unlucky phase, and that happens. That happens. There are investors like that, but ARK Invest as a group of analysts is not just Kathy Wood, right? So I'm gonna stand behind ARK because like there's a few dozen really good analysts that work at ARK that are really looking at some advanced stuff, that are really looking at areas to invest in that really do have long-term potential, actual investments. So, never totally discount anyone's skill, especially at an investment firm like ARK. You know. Yeah, I don't know how. I wonder how that is. ARK. Oh, hold on. First, this is like, look at this. Oh my god, look how badly the S&P reacted to the data yesterday. Oh my god, thing fell 1.5%, and it'll probably waterfall again if the data surprises again today. Let's see here. ARK. ARK Innovation. I believe that's the right one. Damn, look how hard that got hit. Yeah, I still gotta fix this for tomorrow. I'm making some big technical upgrades for range probabilities, so I kind of got that visual stuff on the back burner there. Man. But look, there's been a nice rebound in ARK since May. Oh my god, Kathy Wood is going broke, guys. Kathy Wood is going broke. She's only done about 24% in the last 2 months. She's only done about 24% in the last 2 months. Oh my god, her fund is ending. It's going to zero. She's the worst investor ever. But then again, when you look at it compared to this thing, guys, this is all COVID, right? This is all COVID. However, in all seriousness, this was just, that is just, look, ARK is not going to zero. The company fundamentally is very solid. But this is just, holy hell. This was bad. And you know what? There are still billions and billions of dollars invested into ARK that is bag holding from these prices. And there are still people who are down when they were like buying over here. Some people had to exit some people, they were losing so much money as this was going down. And there are still some people who are holding that are like 60, anywhere between 50 to 70% down still from their investments over here. So literally, if you were investing in ARK any time around here, which is arguably when ARK was making, getting most of their investments, to be quite fair, when ARK was getting they were getting lots of money invested into their fund right around here. And Kathy was saying, no, guys. No, don't leave the fund. Stay invested. And now, at the very least, they've, stabilized. And in all seriousness, I do think that ARK does have a bright future ahead of them because they have a pretty good methodology for, selecting stocks and creating themes and whatnot. But now it's just more or less a matter of, when will those opportunities arrive and at what time, right? Because COVID is literally like you don't get pandemics all too often, right? Like, everyone was so concerned about COVID being the next black plague when it was coming around. Guys, when we were around here, when the lockdowns were happening here in March, right? When like Trump said, oh, we're going to lock down the whole world. Everyone's like, oh my God, this is going to kill so many people. And then there were all these crazy videos come out of, people convulsing in China, just falling, just literally they'd be walking down the street and then they just fall and, shake. And now you see those kinds of things showing up on the news and you're like, oh, that's not good. But, that's just, now it's just the whole COVID thing. This is an investment stream and this ain't a COVID thing, but it's like those sorts of events in the world and in life, they have an impact on where you spend your money and who will end up giving you money. Money doesn't really mean a whole lot if the people who you want to spend it with are not around. Vis-a-vis my story from the very beginning of the stream. There are some people who can't. So I guess I'm in the lucky camp here, guys. And I'll enjoy my time as long as I'm in this camp. I may be young, I may be about 26, but at least I know when I got something nice and not to take it for granted. Alrighty. So what else do we got going on here? Let's check out the NASDAQ. Yeah. NASDAQ for the month. Probably it could make some room lower, but there's a not so insignificant probability that the low is in for the month. Unless you're just anticipating this to be the top for NASDAQ. If you're anticipating us to effectively go sideways, then it's just, yeah, maybe you go back to, just below 15K and you tap it again. I mean, I made a video some time ago, like way back here, saying, hey, there's still a real risk we go down to like 13K, and you know what? If the economy slows down to the pace that the Federal Reserve is anticipating us to slow down, then we might just go that far down over the course from effectively now to the end of 2025, right? That's the forecast, effectively. If the Fed actually gets what... And I do have to, in my trade group, do a little message here. You guys in the trade group will be very surprised by my new position. Very surprised. Oh my God, Joe. He's shorting the euro dollar again? Watch me eat my words as we head into the economic data here for the United States employment. And it just turns out that we just, rocket up like 100 some odd pips. But unlike most people, I know where my risk is. I know, like, hey, if the top here, I'll go ahead and show you what I'm looking at for the day. I'll go ahead and do my trade plan explanation here live on stream, and it's using the range probabilities indicator. So I see, first off, with the closed data here, I see 3 outcomes. And those 3 outcomes are because I see this is a trimodal distribution based off the closes. So you have a cluster here, a cluster here, and a cluster here for where closes for a given trading day have occurred. So either you're going sideways, you're going up here, or you're going down here. Those are the 3 distinct scenarios. Now, this isn't like me saying, oh, technically we can do anything. It's like, no, I can tell you with a precise probability the expectation of these 3 outcomes, right? And while the lowest probability of these three outcomes is right here, right, this little spot, I can at least say, hey, that is a likely outcome if we are expecting bad US data, or actually rather strong US data. The S&P might recover and the US dollar might get stronger as the US economy maintains its strength. So if the US economy, if the employment data comes out good, that could strengthen the US dollar and strengthen the stock market. The whole reason why it would make something like Eurodollar go down is based off of what's called economic relativity. And everything we do in Forex is a relative trade. It's the European euro, in this case, against the US dollar. And what determines the strength of those two currencies is the strength of the European economy, the Eurozone, and the US economy. So if the US employment data comes out stronger relative to the recent really poor and crappy data we've been getting out of the Eurozone, and especially the huge drag on the Eurozone right now that is France and the riots going on right now in there, many stores are closing down for security and safety reasons, right? Less people are going out and spending money and going to shops. Less people are keeping their shops open out of safety for their life. So France is slowing down, and France is a pretty big part of the Eurozone. So the expectation right now is, oh, crap. On top of all the other things we had to worry about economic slowdown, we have these protests going on in France, and we have the ECB hiking into these slowdowns, right? The ECB is just hiking. And the US is like, oh, we might hike if things turn out well. I was actually reading the FOMC minutes, and in the FOMC minutes, there were people in the minutes saying, we probably should have hiked at the last meeting. We probably should have hiked. In hindsight, I keep looking at my analysis and I'm like, dude, they should be hiking. I remember how fervent I was back in June saying they should hike. It doesn't make sense why they don't hike. And now, in hindsight, people at the Fed are saying, we probably should have hiked. Oh, man. Sometimes it's like, sometimes trading is just like that. And I'm getting my stars and stripes, getting those experiences under my belt. But at least at minimum, I know somewhat to anticipate and expect those sorts of experiences, because I've read a lot, I've learned a lot, and I prepared myself for this this form of employment. Anyways, further on to the risk management here for the day on the euro. Expectation is that the top is probably in for the day. So you can see that there are two bumps. So this is where most of your highs occur, in this bump right here. And then this is another bump right here. So either your top effectively comes in very close to the open, and that would be for your bearish trading days, or your top comes in, a bit higher, right? And this is about another 40 some odd pips from where we are right now. Effectively going to this R1 daily pivot. But if we were going to go up there, then how come we got rejected here? We got rejected here. We just got rejected here. I don't know. But I'm going to go ahead and be careful and say, hey, once we start getting around this area right here that I'm filling in, I may want to get out of a short trade. So that sounds reasonable, right? If you're expecting an early top out here based off these probabilities of where you would top out early on the day, and you wanted to be conservative on your stop, well, right there. Because in another regime, in a trading day where you do get a higher high, it would occur somewhere past this point here. It would occur somewhere past this line at 109.05. So if that makes sense, it's like, oh yeah, you just get out there before you see new highs and experience more drawdown. So I went ahead and added to my everlasting euro short, because I've just been shorting this thing this entire time here. I've been getting shorts here, shorts here, shorts here, shorts here, shorts here. I mean, I was shorting it even here during the last ECB meeting, just saying, what the hell is going on? And man, have I managed this risk phenomenally well. Oh my God. Phenomenally well. It's all about not putting your whole, not putting all your eggs in one basket, right? Don't do the 1% trades, because the 1% trades will very, very quickly lead you to Brokeville. All you got to do is lose 3 or 4 of those 1% trades, and boy, oh boy, do you have a little bit of work to do as far as making good, profitable decisions multiple times in a row to make up for that. Or at least making good, profitable, consistent, and positive expected value decisions for your trades over a longer period of time to make up for those steep 3, 4, 5% drawdowns. Just the volatility is nutty. So under this expectation I got for the high for the day and the risk management that I got for, well, if you get higher highs, don't want to see those, so just get out before that happens. Well, let's go ahead and do the same analysis on the downside. Right here. So either your low comes in roughly, most of the time your low for the day comes in around here. Kind of where I've done these little hashes. You see how we have this bump, right? And not only that, but you can see how we've actually bottomed out here so far on the day. But remember, deja vu from yesterday. We literally went all the way back down to the low from yesterday after rallying something like 70 odd pips. The deja vu would be, it's got everyone on edge. Just based off the economic reaction we had yesterday to the surprise positive economic data. If the data even comes out moderately all right today, which, by the way, is in about 15 minutes from now, so we won't have to speculate for too much longer on whether or not I'm going to be making, an extra couple hundred pips today or not. Maybe I can pull off the exact thing I did yesterday on Aussie dollar today here. Let's see. I mean, in the meantime, it'd probably be a good idea for me to take requests for like the next 5 or some odd minutes. Also, I'm starting up the Financial Juice Squawk live stream. So in the background, if you hear a guy talking, it's our good old friends at Financial Juice. So let's see here. James, pound dollar. Dude, thanks for all the suggestions. And I'm sure I'll be able to help you out here with a little bit of analysis here on the pound dollar for the day. Oh my God, look at that crazy volatility here. Oh my God, yeah, this thing's probably topped out for the day. Jeez. I mean, either you've topped out for the day here, right? Most of the time your top comes in here. I mean, I'd say that your risk is once you go above this R1, you're probably going to go up here because you see this, you got a little bump, right? You got a little bump in your probability distribution up here for where your tops occur. So this is this pattern shows up all too frequently with pivot points specifically. Oh, and then the downside is like the total opposite side of the story. Oh, I love this. So, real quick, I want to do a little rant here before the economic data comes in. And for any of you guys who keep asking me about, pivot point trading strategies, I'm about to give you literally a breakdown of some of the fundamental assumptions that even PhD economists have struggled with when it comes down to using pivot points for any sort of trading analysis. And one of the reasons why I really like using range probabilities, and specifically just using pivot points as reference points in a probability distribution, as threshold levels. So listen closely. So notice right here, this R1 pivot, how most of the time your top comes in below the R1 pivot. This follows the assumption that most people have when it comes down to trading pivots, that when you have price, the high and the low, between the R1 and the S1 pivot, that's a range-bound trading period, or that pivot point, right? So if we did this, and then that, and this is range-bound, right? And that's a perfect world. Most of the time, when we trade pivot points, you get a range-bound trading period. And you can have a series of range-bound trading periods trending up or trending down based off where you end. So you can have your down, and then you're up, and then you close like that. And then you do this over and over and over again, and your close is consistently above your open for the day, and you're going to have this positive trend with relatively nominal volatility. So understand that the baseline expectation that I have for deciding whether or not we have a pivot range occur, or if we're going past the range, that is, price, the high is moving past R1 or the low is moving past S1, is exclusively based off my expectations for the volatility on the day, which can be quite unpredictable. So this is where these sorts of probabilities can come in handy. Also, there's another problem of using pivots when it comes down to thresholding levels. So notice right here in the high data, it's very clear, like, oh my God, once you go past this R1 pivot, you're probably going to go into this zone right here between R1 and R1.5, because it's the next most likely zone with the next highest set of probabilities. But then when you look down here, it's like, oh, maybe your top comes in really, your bottom, right, your low for the day, comes in just between central pivot and S0.5.
At 8:30 a.m. Eastern Time, we get U.S. non-farm payrolls. Forecast 230K on the...
I'm going to mute you for a sec. I'm on a roll here. So this, what I'm trying to point out, notice how we have a bump in the distribution right here and then another bump right here. Notice where this second bump lies. It's below this S1 pivot. This shape, this statistical property here, changes based off what asset you look off of, but this frustrates those PhDs because it's like, oh, in some situations when you go past R1, it makes sense to target R2, but in some situations, you just want to target just past the S or the R1 pivot and then go back higher. when it comes down to these technical trading tools with what are called point forecasts, where you're just given a single data point to make your decision based off of, it can lead to a huge degree of inefficiency. When you start looking at your whole distribution of risks over many points with a magnitude and a probability, you're able to get a much clearer picture of, oh, I should put my risk here at R1 because going past R1 means we're more likely to go into this zone here where the probabilities increase. Or, oh, maybe instead of putting my entry right here just above the S1 pivot, I should be putting it maybe 20, 30 pips below the S1 pivot, because most of the time we actually bottom on this particular asset for the given look back that we have here. Most of the time, just right here below the S1 pivot. So if you're not looking at the what's called idiosyncratic risks, the unique risks to the assets that you're looking at, and creating simple little distributions, identifying those risks, you're not gonna even have the basic information you need to start making very simple risk management decisions. Because you could take these distributions and these statistics to infinity and beyond when you start doing, multivariate distributional analysis and joint probabilities and all that. This is very simply, hey, given the returns for where we bottom out or top out for the last 5,000 bars with daily time frames here, just with some very basic, you could say, descriptive information. Oh, how should we manage our risk of this one variable here? How should we manage our risk for our highs? What does the data look like? How should we manage our risk for our lows? What's the data look like? What's the probabilities for that one variable look like? And you'd be so surprised how just getting that little extra bit of data can significantly improve discretionary decisions on, oh, this is a reasonable spot to put risk. This is not so reasonable because I have actual quantifiable data points here. And also I'm taking into account all these macroeconomic indicators and doing all my studying on, what's the expectations for these things? How is the assets that I'm trading going to move based off of positive or negative surprises from this economic data? And then you could say, I'm expecting a positive economic surprise out of this US data today. We're on pound dollar, meaning I need to be aware of this risk down here or of potentially even just down here. So it depends on how big the surprise is. It's like, hey, if it's just a small little surprise, or if we come in as expected on the US data and it's bullish for the United States, maybe you get some like a little down here, right? But if it's a big surprise, like something fuck off crazy like what we got yesterday, this seems more reasonable. And then you can go ahead and say, oh man, if you do start seeing prices below this S1.5 pivot, you're dealing with very low probability events spread over a very wide price range. This is all falling knife territory. And there's a whole set of unique risks for this whole area where you have a lot more uncertainty to the decisions that you're going to be making based off at least this data here. And there are certainly limitations to this data, but having something that's reasonable and actually quantifiable in an actual meaningful way that's been shown to help improve decision making it's like, oh yeah, that makes sense. That seems pretty straightforward. I should probably read the chat here. Where are the numbers dropped at? On TradingView, it's noted at 3 minutes ago. They're dropped here in this little calendar thing. It's right under the hot list with the flame. It's just the little calendar list here on the right hand side. I'm gonna da, da, da. Oh man, I hit 12 viewers on that little rant. Wow. You guys really liked my my rant there. Wow. Alrighty. Let's go ahead and turn financial juice back on.
5%. US labor force participation forecast 62.6%. On the prior, 62.6%. US manufacturing payrolls forecast 5K on the prior minus 2K. Looking at more analyst notes, BlackRock says US jobs data in focus this week. We think labor shortages may have made firms reluctant to let workers go, keeping unemployment low even as growth sputters. The focus in next week's US jobs report will be prevailing signs of a resilient labor market, even with tight monetary policy. We see labor shortages fueling wage growth and keeping inflation stubbornly high as companies hold on to workers even as demand drops. That poses the unusual risk of full employment recessions, where the unemployment rate stays low. And notes from ING. Last month, the rise in non-farm payrolls was immensely strong at 339,000, but we do expect to see a moderation with this month, with something closer to the 225,000 mark. The unemployment rate jumped to 3.7% from 3.4% last month, given the household survey data painted a very different picture to the payrolls data, with households reporting that employment actually fell. We see this reversing part of the jump and coming at 3.6%. Meanwhile, average hourly earnings should soften a touch with another 0.3% month-on-month print, which would bring the annual rate of wage growth down to 4.2%.
All right, 2 more minutes and the data comes out here, and it's going to get volatile as hell, guys. Alrighty. And make sure you have your own economic calendar open. There is a delay on the stream, so you will be getting the data just slightly ahead of this stream, although I'll be trading it in real time with you. Alrighty, guys. Best of luck for whatever you're trading. And I'll give myself some. But man, let's get right on into this. Into the deep.
One minute remaining. I'll lead with the US non-farm payrolls.
Get ready. Oh, yield spreads
10
are red.
seconds.
Oh. Whoa. Bearish on the dollar.
209K, 209K, lower than the forecast of 230K. US unemployment rate, 3.6%, 3.6% as expected. US average earnings year on year, 4.4%, 4.4% higher than the forecast of 4.2%. Canadian unemployment rate, 5.4%, 5.4% higher than the forecast of 5.3%. Canadian employment change, 59.9K, 59.9K higher than the forecast of 20K. Seeing some downside in US dollar, upside in S&P. US private payrolls, 149K, 149K, lower than the forecast of 200K. US average workweek hours, 34.4, 34.4, higher than the forecast of 34.3. US average earnings month on month, 0.4%, 0.4% higher than the forecast of 0.3%. US manufacturing payrolls, 7K higher than the forecast of 5K. US labor force participation, 62.6%, 62.6% as expected. Canadian participation rate, 65.7%, 65.7% higher than the forecast of 65.5%. Canadian average hourly earnings year on year, 3.9%, 3.9% lower than the forecast of 4.6%.
All righty. That was over in a flash.
Treasury's pair declines after the June job creation falls short. Canadian dollar extends loss to a day's low after the job report. We have posted the US non-farm payrolls June 2023 full report on the feed for all those interested.
So US
Euro
job
briefly
numbers.
jumps up after June payrolls data, last up 0.17% at $1.0905.
Yep. So US non-farm payrolls came in worse than forecast. Damn.
US short-term interest rate futures rise after jobs data as traders ease back on bets for more Fed rate hikes. The dollar falls against Japanese yen after June payrolls miss, last down 0.7% at 143.05. Yield on 30-year US Treasury notes up 0.2 basis points, last at 4.005%, and 2-year Treasury yields falls up after payrolls, last down 5.8 basis points at 4.948%. The spread between US 2-year and 10-year yields narrows slightly after payrolls report, last at negative 91.5 basis points. Eurozone yields drop after US jobs data. Germany's 2-year bond yield down 4.7 basis points, last at 3.312%.
All right, is that it? Or is he going to keep going? All right, I'm going to go ahead and put him on the mute. Wow. Was not expecting dollar to get so darn weak. I was expecting that the jobs numbers would do considerably better. Oh well. But now, looks like we have to go ahead and check the probability of rate hikes. And I believe he said, yep, it's right here. Short-term interest rate futures rise after jobs data as traders ease back on bets of more rate hikes from the Fed. Sorry guys, just currently managing some trades here, is all. All right, we're back to the prior ranges here. I'll go ahead and show you guys what I'm looking at. Go to 4 hour. Yeah. So I'm looking that we're now back at these prior prices from the very beginning of the week. We'll probably make new highs for the week here, right? Going up into here around R 0.5 on the week. That is, unless we literally just top out right now. But based off that data, I don't see why not, considering that pricing for future rate hikes is now getting discounted. Wow. Whoa. Crazy volatility today. Also, crazy volatility on those prior trading days. Let's go ahead and check out the SPY. SPY rose. Let's go ahead and check things out on the 30. SPY had a nice little pop. Same thing with Bitcoin. Bitcoin also had a nice little pop. And same thing with the euro dollar. Man, am I happy I got out of that Aussie dollar yesterday. Made a good move just capturing the move on that day. And as far as the trade I put on here today, that one went away real quick. But I had some orders here in the 109.2 range. So I was just making sure I watched my stuff. And now I gotta make some posts saying, oh, okay, so this trade got out and this trade got in. So let's see. That was 9. Well, let me know if you guys want me to check out any more charts here. They liquidated me 1 second before the pump. Oh my god. I guess they like to confuse us. Positive yesterday, negative today. This still isn't the best news, because if the United States is, look, there's something called the dollar smile. And if the United States is doing better than other countries, the US dollar will get stronger. And if the United States is growing faster than other countries, it'll get stronger. So whether the United States is the strongest of all the weak countries or the strongest of all the strong countries, the dollar gets stronger. And yep, Rick, I'm still short on the euro dollar. I'm just updating my trades right now in the trade group. And I did actually get some shorts. I'm a fucking bad man. Oh my god. Yeah, I was able to show on the stream real quick what I got. So the way I was able to play literally what just happened. So remember what I said earlier in the stream, how I was like, oh, I can get stopped out right around here. Well, I did. I did. And then roughly right here, I was like, hey, this is actually a really good spot where most of your highs occur before you start tailing off. So I had stops on orders to go short here at R2. So I got hit on those. I was like, uh-oh. Is this thing just going to rocket, stop me out twice, right? Up, stop, and then up, stop? No, it just went one. I only got stopped out on this one, caught this, and these trades are doing fine. And these trades are actually making up for this loss right here. But I gotta watch myself because I could very easily still lose on the day. I went ahead and I just made a post in my trade group, posting my exit, which when you exit on a short trade, you have to buy back the position. And so I posted one buy order and then another sell order. And like I said, the sell order is here in the early 109.2s. So, yeah, I've effectively paid back because I got stopped out for about 15, 20 pips, and right now I'm up on this new position about 17, 16 pips. It's fluctuating quite a bit. So, yeah. I've on that one stop I've made about, and then on this one trade I've made about, I'd say 70, somewhere between 65, 80% of my money back so far on the open trade. And then, well, if Euro continues to do horribly on their economic front, which is my baseline expectation, and I gave my reasons for why I think that going into the beginning of the stream, with all the things going on in France and whatnot. Also, I have some month-long expectations, some monthly probabilities, right? So while I'm showing you my trades based off these daily probabilities and trading these events and whatnot, it's in the context of, oh, shit can still really hit the fan going into the month ahead. I mean, my expectations for Eurodollar is we're going to go into the 107s sometime this month. I mean, I still even think that even if we don't go into the 107s, that at least at some point this month, we're probably going to see 108. Because even with the ECB hiking, it's not as strong as the United States is. It's just not. More people are going to be buying dollars to invest into a growing stock market if the Fed doesn't hike again. And if the Fed does hike again in July, they're going to effectively ruin the ECB's gains as far as the euro strength goes. Look, the way I see the macroeconomic setup for Europe is that it's kind of a lose-lose right now for them, unless China actually has a rebound in its growth. And also they have the whole Ukraine-Russia thing as the monkey on their back. So not only do they have all these, geopolitical problems going on internally within the Eurozone, they have all these external geopolitical problems. And the internal geopolitical problems are caused by their macroeconomics, right? Vis-a-vis the ECB hiking into a slowing economy. So it doesn't necessarily matter if the ECB hikes, if that'll actually appreciate the euro. Because as the ECB hikes, it's going to induce weaker economic data prints. And those weaker economic data prints have more of a say on the movement of the euro than just stand alone the single variable of the cash rate at the ECB. Although it does have quite the impact, right? But understand that we're trading it in relation to the US dollar, which has far fewer of these problems. So the question now is, based off this data, will Eurodollar hold the 109 range? It's hard to say. Hard to say. But, I'd at least expect 108.5 sometime next week. So we'll probably reach the lows again from this current week here on Eurodollar, right? These lows around here from yesterday will probably come back down to these prices again at least sometime next week. Because nobody likes the European Central Bank hiking into a slowing economy. So let's see here. We have a bunch of German economic data coming out. And we have RBNZ. Oh, right. We have on July 11th, we have RBNZ statement. Yeah. We have New Zealand information coming out. Bank of Canada rate decision next week. We have a bunch of central bank stuff next week, guys. And then we also have a bunch of European data as well. ECB minutes, OPEC monthly report. Oh, European Union economic forecasts on the 13th. Also, the Bloomberg Surprise Index. Oh, no, rather, it's the Citi Economic Surprise Index. The Citi Economic Surprise Index is very, very negative still for Europe. So I don't have too much hope that the economy is going to positively surprise on these data points. Yeah, there's no single variable you can follow that'll make you money in trading. It's always, always, always going to be a collection of variables that you have to weigh. And that's one of the reasons why people like AI, because it's a method of just shoving a bunch of data into a program, and then that data algorithm, the AI, will figure out how to weigh all that information for you. That's why a lot of people like using AI for trading and stuff, but you just got to feed it the right information and the whatnots. It looks like we've reversed here on the SPY, and Bitcoin hasn't held its gains, and oil is still going sideways. Yeah, the aftermath. Oh, yeah, and then there you go. Dollar is still holding in here. So these were probably some good buys on the dollar. Oh my god, you can even see it. It's like right at the edge of its distribution. See? Unpredictable spot where you can fall down to, and then this is all tail risk. So it's literally you're buying right at the edge here, right here, stop below S2, all this tail risk. So it's like, so now it's a question of where do you close? Well, you probably end up closing sideways based off this data. Let's go ahead and check out the S&P. Looks like we have a bit of a negative, little bit of a negative drift there. Same thing with the Bitcoin. things are looking pretty bearish here on the short-term stuff with these distributions. Alrighty, you guys. Hang out in the voice chat in Discord. Gonna continue managing my own trades. Gonna continue talking in the Outlooks channel about some of the new outlooks that I got sent for the week ahead. And I'm gonna enjoy the rest of my weekend. Get some trade planning done with everyone in the trade group. On Saturday, there'll be a video for all the week ahead trade plans that I do. So we'll know what we want to do for the week ahead. We'll know all of our trade plans, all of our risk management for the whole week ahead on like 60 different assets. So if you guys want to hang out, chat for a bit, hop into the Plan the Profit Discord, come say hi. And I'll see you guys in a bit.